Hey, what's going on YouTube? How are you guys doing today? We are just getting back. We're just going over the basic fundamentals of how velocity banking takes place. So to recap, so if you're just tuning in right now, let's recap what we kind of went through. So the average household, we're talking two-income household, everybody. And this expands from Hawaii, of course, to New York, Florida. And so taking the averages of that two household income, at the end of the day, they're bringing in $5,000. So that's what we start with here. And the principle of velocity banking is, where do we put that money? Well, if you're thinking like I'm thinking, it goes into our checking and savings account. Then we put a little piece for the mortgage. We put a little piece for the car. Put a little piece for the credit cards and our lifestyle, try to save a little bit of that, whatever's left over. But the problem, folks, when we start to do that, we're living on the cash basis mentality. That's what they wanted us to do. Separate our money out. You know, don't keep it all in one place. They want you to start to portion it out. So you have to make sure that that money is, you know, set aside, because if you don't set it aside, you could be into some trouble. Now, what we're taking a look at here is lines of credit on this side. These are credit cards, typically 3 credit cards and average limits of $15,000. So that could be a couple different credit cards adding up to total limits of $15,000. And this is shocking. The average household today is carrying a $12,000 balance on that. Yikes. So on the other side here, we have the loans. Now, the biggest loan that many people have is their house. So we have a $200,000 household. That is the average house price across the country. And the average percentage rate on that is 6%. Now, I also have over here under the loan side, we have auto loans. The average auto loan amount is $13,000. And so as we look at that, we have our mortgage paid, we have the car paid, we have the credit cards paid, we have our lifestyle, we're trying to save some. At the end of the day, $5,000 comes in, $5,000 goes out. Zero cash flow. That's the problem with the current model, is we're living 30-day mentality, 30 days. And sometimes, let's be honest, we run out of money before we run out of month. That's how we rack up credit card debt, or we're already paycheck to paycheck and then the tires go out. So then we need to put it on the credit card that was developed for emergencies only. That's always the big problem, folks. So how do we bust through that? How do we get out of that cage that the financial system has entrapped us with? Well, what we were talking about is velocity banking. If you've been tuning into CJ's channel, you've been hanging out with the wise guys in ties, you've been following along and understanding some of these principles. But tonight, it's just, we're gonna change it a little bit on you, and we're gonna make it even easier for you to be able to gain access to that. Now, of course, we're gonna go over a lot of information tonight. So of course, you can visit us at wiseguysandties.com, but text credit 602-497-2257, and that way you could get an ebook and also a free 30-minute consultation. What you're going to get in that ebook is all the discussions of how to actually access credit without using your personal credit. What? Yep, that's right. Master money man Joseph Smith is going to be talking about how to incorporate business credit into this. And regardless if you ever thought about starting a business, you're going to need it to implement the velocity banking strategy. So as we go through this, we know that the model is broken. We know that there's zero cash flow at the end of the day. So the principle of velocity banking is to take our income. If you follow me on the green, we're going to drop all $5,000 onto the balance on our lines of credit or our credit cards. Then we do not have to budget that monthly payment. So when we have a monthly payment of $600 that's due to credit cards, and like we said, this could be multiple different credit cards. When you drop a lump sum on there, you don't have to necessarily budget for that payment because you've overpaid. Does that make sense, everybody? I hope you're following along because we're moving along pretty quickly. Over here, savings, 401ks. If you are hemorrhaging, and I mean you are bleeding through interest rates, you don't have the ability to save in your 401k if we're bleeding everywhere. But let's talk about that. Where are we bleeding? Well, we have the loans over here and the lines of credit. They're charging us 21% interest over here. They're charging us 6% over there. Are those the same? Let's take it back a little bit. Let's talk about that. Are those the same? What are they actually doing to us here? Well, let's go back to 8th grade earth science. 32 degrees Fahrenheit. That is the temperature in which fresh water freezes at sea level. Everybody agree with that? The equivalent is 0% degrees Celsius. That is equivalent to 32 degrees Fahrenheit. Those are both the temperatures in which fresh water freezes at sea level. Now, this is a 0, this is a 32. How can that be? Simply because they're different calculations, they're different scales. So you'll see a lot of times we talk about, okay, which one is hotter? If we move to 1 degree Celsius, which one is hotter? 32 degrees Celsius or 32 degrees Fahrenheit or 1 degree Celsius. In that scenario, of course, the 1 degree is hotter because it's a different scale. Now, we do this to show you a principle here. 6 degrees Celsius, which lines up with 6%. 21 degrees Fahrenheit, which lines up with the 21%. We ask you which one is hotter. Our instinct is to say 21 degrees, but since it's a different calculation, we know that the 6 degrees is hotter. This percentage is a different calculation than the 21% that we see on our credit cards. We associate our credit card percentages with the simple interest formulas that we learned in high school. What is 21% of 100? Well, 21. It's a very easy calculation. This over here is in a payment schedule. It is amortized. It is a loan. It is, you get the money and then there's scheduled payments to actually pay that debt back. The problem is, the equation to actually calculate amortized debt is something you might not even see until your 4th year of calculus. It is so intense, it's one of those that take multiple pages of paper just to calculate. You have to use a special calculator just to figure it out. Now, this looks like 6%. We think it's 6%, but it's not 6%. An easy way to convert it is we take the number, or the percentage rate, 6%, and we double that. So that equals 12. Now, we're going to multiply that by 10, which would give us 120. That's not exact, but it's pretty darn close. True is about 116%. What does that equate to? That means that on a $200,000 loan, over the course of 30 years, if making your payments, $432,000 would be paid back. More than double of the house. Does that look like 6%? It does not. And especially when you understand that most of that interest was paid in the first few years. So how do we offset that? Well, look at this. This is an amortization schedule. What we're talking about is very little amount goes towards your principal. So your principal is how much of the actual house you're paying for. In the beginning, very, very little is actually going to paying down your true debt on the property. Majority of that is the interest. And in the beginning, it is heavily interest loaded. So $950 is going towards interest, only $250 is going towards your principal. If we look at these ratios in the beginning, in the payment to interest, the principal to interest, the ratio there is, we're talking 300% markup of interest. So that's the problem. In the first few years, hundreds of percentage of interest. Over the 30 years, you know, as these shift and you start paying more towards your property than you're paying interest, it balances out to 116%. But those first several years that we're in this, hundreds of percentage of difference. Now, what do people typically do around year 5 or 7? You know, between 5 and 7, sometimes now it's moving up a little bit closer to between 5 and 10 years. You know, people are staying in their houses a little bit longer. But the problem with that is, as soon as year 5 hits, every single person knows what a refinance is. And I challenge you to ask yourself, why do you know what a refinance is? How have you heard about a refinance? And why is it that every single person in the country has heard the word refinance? Think about other things that you know. And think about how much, have you heard of Coca-Cola? We have. How much money has Coca-Cola put into their marketing so you understand what Coca-Cola is? A substantial amount of money. And this is what I'm talking about, folks. I'm talking about why has so much money from the banks been pumped into refinancing. If it is so beneficial and it will save you so much money, why do they consistently mail and advertise and mail and advertise? They will put hundreds of billions of dollars into advertising refinances because it's going to save you money. That is right, folks. It will not. And so I encourage you to stick with us, because when it's a one-directional loan and you get the money up front, it's not an efficient way to use our funds. Over here, I'm going to challenge you to start coming to the credit side, to the simple interest side, where we have a two-way street. It's a win-win situation. It's a compromise. It's money can go in and money can come out. It's not locked in. It's not set in stone. Over here with the loans, it's very, very hard, and we don't really have any way to affect it without paying extra into it. Let's take a look at how much interest we're actually paying in a loan in those first few years. Let's take 60 months. 60 months and making our $1,200 a month payment. Now, we're not calculating your taxes and your insurance in this. We're looking at principal and interest only. 60 months, $1,200, $71,000 that has been paid back. Think of that. 60 months, $71,000, almost halfway there. Principal, $13,000 has been actually going to the pay down of your house. $58,000 of interest. Let's just look at that ratio right there. So in 60 months, pay down $13,000 towards principal. $58,000 went towards interest. Does that look like 6%? But even better, does that even look like 116%? If we were to do the math on this and figure out what the ratio of difference is, let's see. 13 would go into 58 how many times? How many times, Mr. Smith? Let's see, we go to 26, that's 2, and then we double that, 26, 26. That gives us, we're going to go to, let's see.
4 times.
4 times. A little over 400%. So actually, it's actually more. So I don't have my calculator right here, but it's actually more than 400%. And that's the thing is, yeah, over the course of 30 years, we're going to pay 116. But we're talking in the first few years, look at that ratio of how much interest they were taking, over 400%. It's absolutely insane what the banks are doing. They want to get their money, and they're going to get it fast. So that's the true understanding of what loans are doing. It's happening with your auto loans. It's happening all over of everything that has a loan attached to it. Oh man, and I tell you folks, if you're just tuning in, don't forget, text credit 602-497-2257. That way you can get the ebook on how you're going to be building your business credit and implementing velocity banking in your life starting now. All right, so let's go back to where we're at. We know that we're done over here because of the loans. We know that over here we can stick with a simple 20% interest rate. And this is the great thing. That is an annual percentage rate. But wait a second, Ray. This is also an annual percentage rate. Yes. But we take 21%, you divide that by 12 months. And that is what you're going to actually be paying each month. Less than 2% each month. That's the power. Would you rather pay 400% or 2%? You tell me. All right. So as we move along in this, we talked about the principles of velocity banking, of taking our $5,000 and dropping it all onto our credit cards, offsetting a substantial amount of that debt, which is calculated daily. So that is interest that that is money that or debt that I should say, that we're not paying interest on.
You want to explain the W-2 up there?
Yeah. Let's go over that. So before we move into this, let's talk about where our mindsets are at and why we even believe this in the first place. The banks have taught us about this. Your parents have taught you, or the banks taught your parents. Either way, it's come from the schooling system, the banking system, and everybody has been geared to think a certain way. Our schooling system has taught us to think a certain way. It's taught us to think as a W-2 employee. Everything in the world has changed except for the way that we are teaching our children in school. Cash as currency. So when you're a W-2 employee, you trade your time for money. And so we understand that we use our cash as currency. It's demonstrated here. Cash goes into our account. We separate it out to pay our bills. If there's nothing left over, then we're out of luck. So we use all of the money we get as our currency to pay our bills. And people say all the time, oh man, I'm in so much credit card debt. I wish I just went back to when I just paid cash for everything. Folks, you don't understand. That's why you got in the problem in the first place, is using cash for everything, because they told you, get a credit card for those emergencies, but stick to budgeting and use your cash. Only keep cash in your pocket. Don't spend your credit card. That's what they told you to do. And so every time somebody's like, oh, I'm in credit card debt, I should have just went back when I only used cash. That's the problem. I can't say it enough because this is such a huge point that people gotta understand. When you're only using cash and emergencies happen, you have no other options but then to use the credit card that you couldn't afford in the first place. So thinking that the credit card was the problem is not. Using your cash to buy things is. That is the problem. The wealthy understand this. The wealthy understand that leverage is a currency. Being able to control things is the currency. Leveraging their ability in other people's finances, other people's money, for example, credit, leveraging that to their ability to be able to offset their debt. Now, they use their leverage as the currency that they use transactionally, but that's not all. The cash is then used as the velocity, which is the force of which things are paid down. So we use leverage, but then the cash that we have all goes to affect the debt. It's a very, very powerful concept. Now there are rules. We stick with emergencies. Yes, credit cards are used for only emergencies, but that's not all. It is also used for debt pay down. That is not what they told you it was for, right? When you got your credit card, did they tell you? It is also for debt paydown. You're like, what? How is a credit card for debt paydown? And it is for assets. Acquiring things that are actually going to make you money. There's good debt, there's bad debt. Let's stick with going for the good debt. Now, so we saw this, we saw the money's coming in, and let's take a look at that. So we got our $15,000 limit. So $15,000 over here, we're carrying a $12,000 balance. As we put that $5,000 onto there, it's going to drop it significantly. It's going to instantly bring us down to about $8,000. That is a great situation. So when we do that, and we didn't have to budget for our credit cards, we didn't save, because if we're paying over 400% on the mortgage, if you're paying over 400%, why on earth are you concerned about getting 4% in your retirement fund? You are bleeding and losing the game. And everybody's like, oh, 401k. 401k is not designed to save you, folks. 401k is not going to, it was a supplement to pension funds. There's no pensions anymore. I mean, if you got a pension, that's great. 401k is not a retirement plan. It is a supplement. And if you do not even have your house financial in order, you can't even supplement. How are you going to supplement something to nothing? All right, I'm sorry. Let's just get heated on this because it's such a problem in the economy. So we're not going to be throwing money into our savings until we get ourselves out of this massive debt. We're not going to be budgeting for our credit cards because we're dumping everything on our credit cards. So as we put $5,000 in, we're not saving over here, we're not doing over there. That adds some cash flow. That frees up $2,000 of cash flow. And that is starting to turn a zero cash flow situation into $2,000 of cash flow. So let's go back over here. So we have our line of credit. $15,000 balance, or sorry, $15,000 limit, carrying a $12,000 balance. We dropped our $5,000 on there, but we have $3,000 worth of expenses. So we're at 12, paid down to 8, recharged back up to 3, leaves us at 10. So that is a pay down of $2,000 in 1 month. If we continue a $2,000 pay down each month, how long will it take for us to pay off that $12,000 when we're paying it down $2,000 a month? So let's see, 1, 2, 3, 4, 5, 6. Half a year. Half a year, congratulations. You just paid off $12,000 of credit card debt. That's amazing. So then what do we do from that point? Well, we got a problem. Our credit cards are paid off. Whoever thought that would be a problem? Well, it is a problem because that money can get spent on something that it should not. So let's put it to work. Let's take a look. What are we supposed to do? Emergencies? Hopefully we have none. What next? Debt pay down. Do we have any other debt? Well, our credit cards are gone. Yes, we have a house we're paying 400% interest on. Absolutely insane. So what we're going to do is we're going to transfer $13,000. Now that's what we're going to get into a little bit later on how to actually do that. But $13,000 is going to get transferred over to our lines of credit. You're like, whoa, why am I going to do that? Paying my house with, oh, stay with us. We have a $15,000 limit? Or do we? Are we still at? We're still at what? Well, let's see. If you've used your credit line accordingly, most likely they gave you a credit limit increase. So we're going to put $13,000 on that line of credit from our mortgage. Transfer it over here, paying down with our $2,000 a month, 6.5 months. It's paid down. Let's go over here. That $13,000 versus this $13,000. This $13,000 that we used our line of credit for, 6.5 months with a total interest paid of $1,440. So let's take a look at this. $1,100 or $440. How much interest over here? Would you rather pay $58,000 or $1,400? It's a no-brainer, folks, and that's the problem. Is the bank does not want you to understand this. The system does not want you to understand this. The schooling system does not want you to understand this. By doing so, we can get your mortgage paid down at a rapid rate. 5 to 7 years, your mortgage is completely paid off. Especially, let's take a look if we're starting even from year 5 in. All right, so what do we do with that? Let's say we've moved through this process. 5 years later, our house is paid off. So we have a house that's free and clear, worth $200,000. We have our cars paid off. We have no debt. So now, what do we need to do? We need to go get some assets. Because do you want to be working for the rest of your life? Do you want to be 85 years old and still working the door at Walmart? Do you want to be at the gas station? It is an epidemic now, and I tell you folks, it is not going to get any better. If you are anywhere close to retirement, you know that's a serious problem. And if you are in your 20s, your 30s, your 40s, you better start thinking about it now, unless you want to work forever. So, we're going to take this house. We're going to go out and get a HELOC. A home equity line of credit. We're gonna, it's 70 to 80% loan to value. So that's how much money we're actually going to be able to access of the equity. Gives us $176,000 to work with. What are we going to do with that? Well, let's go buy some more properties. We're going to implement something called Subject to. It's very hot right now in the market. I'm in the process of doing one right now. People will literally give you their house. Take it. If you did not realize that was taking place, you are missing out. If you don't realize that people are out there literally having people take their houses away from them, and not having to qualify for credit, not having to qualify for a loan, and just having to make the payments, how many payments could you take over with $176,000? Let's say it takes you $20,000 to even get into one of these deals. Well, at $20,000, you could get into 8 of those deals, helping other fallen angels get out of their bad situation. So we get 8 houses, and we start to run that through the same system. Accessing lines of credit, paying down the debt, and then in a few years, when you have a couple of these paid off, you could sell the other ones to pay off the rest. We're using the rental cash flow, the rental income, nightly rentals. There's so many different solutions to being able to cash flow a property. It is the ultimate way that you are going to grow your wealth, because I tell you folks, I'm doing this because everybody knows that the true way to become wealthy and successful in this country is to start a business and store it in real estate. Everybody knows that, folks. So I'm not telling you anything you didn't already know, that all millionaires are created, or most millionaires, unless they won the lottery, which you have better chances of getting struck by lightning, I think, 4 times than actually winning the lottery. But I'll tell you, if you've made it to this channel, you've already won the lottery. Because you know how many people wish they heard this before they refinance? They wish they heard this before they even bought a property. And I want you to go and buy as much real estate as you can, but make sure you do it the right way. And that's what CJ Wallace is here for. CJ Wallace is committed to making sure that you guys do real estate the right way so you don't lose money. Wise Guys in Ties is committed to helping you do real estate. Build your business finance. Do it the right way. That's why, get the free ebook. Go to our, and when you get the free ebook, you get a free 30-minute consultation, financial consultation. Ask us about this. Hey, I want to know more about that velocity banking and implementing it with my business credit. How do I do that, guys? Talk to me, talk to Joseph, talk to CJ. Let's get you on the phone. So, what I'm going to do is I'm going to pass this over to the money guy. He is known as the money guy. Why? Because he's the master of finances. He has the ninja-like skill of raising capital from out of nowhere. All of a sudden, what does a ninja do? They swoop in and they kicked everybody in the face, and you have no idea what happened. That's what Joseph does. He comes in and it's like, wha-bam, wha-bam, wha-bam! $1 million raised. That's what we're doing, guys. Man has just surpassed the $1 million mark of capital in just the last, 18 months or so. Woo! What could you do with $1.25 million of money? So, enough about me and him, or actually, I'll just let him take it over from here. Mr. Joseph Smith, everybody! Woo-hoo! Hi-ya! Hi-ya! Oh my gosh!
You didn't know I could kick that high. All right,
There you go.
Thanks, buddy. All right, hey YouTube, thank you so much for being on here tonight. Love working with you. Thank you to CJ. Thank you, obviously, to Mr. Ronaldo Fleming. Wasn't that awesome? Velocity banking. Velocity banking is awesome. It's great. In fact, I'm going to have to move a little bit. Can you all see that? All right, good. So, velocity banking is great, and it works perfectly if you have a line of credit, right? Line of credit, credit cards, what's the difference, right? Credit cards are little pieces of plastic, right, that you can get at a 0% interest rate, and then you can swipe it anywhere at a point of sale. Wonderful, great tools. I mean, you can use credit cards everywhere, except sometimes there are people who won't accept credit cards. So what do? Well, that's what's great about a line of credit. Now, a line of credit gives you access to the cash, right? Credit cards give you this great low interest rate. Access to cash, low interest rate. So if you want to access cash off of a credit card, they don't let you take all the cash out. And what cash they do let you take out, it's a cash advance, is at a higher interest rate. So line of credit, credit cards, we got to go with the line of credit. Line of credit's awesome. Getting that HELOC, personal line of credit, awesome. Using velocity banking with lines of credit, awesome. Credit cards can be awesome, but sometimes it's not so awesome. I want to introduce you to a good friend of mine. I don't know if you can see him over here. All right. His name, here he is. His name is Max. Right? I call him Max. Why? Because he is maxed out. Right? He is totally maxed out. What are we talking about? Well, his credit score, right? His credit score is way down. I mean, it's so far down that we didn't even know that credit scores went into the negative. It's that low, right? That's Max for you. He's so sad because, why? Well, he's sad because of his DTI. What's DTI? His debt to income ratio. He's got so much debt and to his income. It is through the roof. Nobody will lend him money. See, here's Max. He's got his little house here. He'd love to get a HELOC, right? He might even have a little bit of equity. A lot of people who pay on their mortgages, they're paying their amortized payments, and they feel good because I've got equity. Well, what good is equity if you can't even access it? It's like it doesn't even exist. It's like equity. What do you mean equity? Can you go to the store and buy a loaf of bread with your equity? Good luck, right? So equity only means something if you can access it. But if your credit score is down, your DTI is too high, right? What about utilization, right? We talk about utilization all the time, or at least CJ does, right? CJ's on the line right now, and he's texting you guys. He's right behind the camera on the computer, texting you. CJ, you keep texting and communicating with those people. All right, but utilization, well, Max either has his utilization at 100%, or he's so maxed out that he doesn't even have credit cards anymore. They close the accounts on him because he's been maxed out for so long. But let's say in the example that we used earlier, pull the board back this way. Remember, we have this $15,000 limit. Let's pretend for a moment that that's on 3 different credit cards. 3 different credit cards. So $15,000 limit, you have a $5,000 MasterCard, $5,000 Visa, maybe a $5,000 American Express. Okay? Now to carry a $12,000 balance, let's say we have an equal, that balance, that debt is dispersed evenly on these 3 cards. So $4,000, $4,000, $4,000. You following me? Are you picking up what I'm laying down? So let's look at one of these credit cards. Here is one of Max's credit cards. Here's his everywhere you want to go card, right? And what has he got? He's like, yay, I've got a $5,000 limit. Woohoo, $5,000 limit credit card. But he's carrying a $4,000 balance. Boo. So he's like, wait a minute, I saw this velocity banking stuff and I'm gonna give it a try. But see, here's the thing about Max, is Max, you see, he has been maxed out for, 6 months or more. That means his credit cards have been maxed out. He's only been making his minimum payments. But he says, you know what, I'm gonna take all of my income, right? Remember, he's got that $5,000 in income, right? $5,000 income. What's he gonna do? Bam! He's gonna put it all on the card. And so what happens, all my math majors out here, if I put $4,000 onto this balance? If I have a $4,000 balance and I pay $4,000, what happens to my balance?
Goes down.
It goes down. Let's say it's at 0. That's pretty good, right? Yay! Except for, look at this nasty little trick that the bank sometimes does to folks who are maxed out. That $5,000 limit that you had, it also drops down by $4,000 that you paid. So now your limit of $5,000 is gone, and now you have a $1,000 limit. Now you're like, wait a minute, I put $4,000 on the card. I wanted to do velocity banking, but now I can't. I feel like I just lost $4,000. We've had some people come and tell us this. This is where the rubber hits the road, folks, where you feel like, wait a minute, velocity banking, that doesn't work. It does work. It's optimal if you use a line of credit. Now you can use credit cards or credit type revolving accounts, but you got to be careful. Sometimes when you have a card that has been maxed out for a very long period of time, the creditor's not sure that you're going to pay them back, and they see their opportunity to lower that limit because they don't want you to rack up that debt again and go months and months and months without paying them. So you've got to prove yourself again. This is a very sad reality for some of our folks. So how do you do velocity banking if you're max here? If you're maxed out, if that's you, sometimes being maxed out is you don't even have any credit cards, right? How do you do this? Well, let's talk about another issue. Max, right, he's over here. I'm going to draw a picture here, but you can really make it whatever you want. But let's say we have this little building over here, and I'm just going to call this your business, all right? It's like a little storefront, okay? This is your business, right? Here's your business, and we have over here again, here's Max with his business. Maybe he doesn't even have a business, but let's say he does have a business, and Max, again, he's sad. Why is he sad? Because for the business to work, for the business to thrive, it needs 3 things. Because 90% of all businesses fail in the first 5 years. Because they don't have cash flow, right? They don't have credit. And 3, they don't have collateral. So here's Max. He's maxed out. He doesn't know what to do. He's got this business. He's got an idea for a business, but he can't start it because what is every business's challenge? And this is every business's challenge. No cash flow, no credit, no collateral. What are we going to do? Well, Wise Guys in Ties has put together what I believe to be a brilliant plan. Just ask me. Yes, I do. I think it's a brilliant plan. We suggest that Max use velocity banking strategies with business credit. You're like, well, how do you do that? Well, let's go over here. With business credit, right? Business credit is built off of an EIN. Max's credit over here, that's built off of his SSN, his social security number. See, an EIN is a business's like social security number. It's the tax ID. and you grow your credit off of your tax ID. So with this business credit, when you start working with the wise guys and ties, you can grow your business credit very fast. We're talking about getting $50,000, right, in lines of credit. Right, lines of credit. We're talking about vendor credit, revolving store credit, fleet credit, cash credit, unsecured high limit credit cards. Right? This is amazing. And what's the time frame that this can be done in? This could be done in 6 to 12 months. So I'm hoping you can see this on the board, but here's what happens when you start working business, right? A business, but you need business credit. Business credit allows you to build business off of your EIN, right, to the tune of $50,000 in lines of credit in 6 to 12 months. Now, what's something we can do with that line of credit? Well, remember we said it's a good mix of different types of credit. Let's take of this $50,000 here, let's say Max wants to take out $25,000 in business credit card here. Okay, here's what he wants to do. He wants to take it out from the business and come up here and give it to the personal side. Well, how do you do that? I mean, that's like the left hand giving the right hand some money, isn't it? I mean, that's going to create accounting issues. That could create tax issues. How do we do that? Well, let me show you how we do that, right? We need a third party to do this. So, Max has got his house. So, here's what Max is going to do. The business is going to give basically a loan with a deed of trust or a mortgage against the property. How do we do that? Well, we need some third party intermediary, like let's say a title company. A title company. Here is another entity. So what do? The title company will help Max put his $25,000 private mortgage note in second lien position. Second lien position. Not bad. So this gets recorded at the county, right? It's a lien against the property, an equitable interest, right? And in return, Max has got to make payments on this note. So let's go back down here. When you get these lines of credit for your business, they typically come in at 0% interest for anywhere from 6 to as long as 24 months. So Max is going to take $25,000 in unsecured high limit credit cards, 4 or 5 of these credit cards, and he's going to give it over here to the personal side. Even though they're business credit cards, he's going to treat it like a full loan, as if the personal side spent all $25,000. So a $25,000 private mortgage note is going to be put as like a second mortgage in second lien position against the property. Because remember, Max is maxed out. And we already showed you all the way over here. Look, this is why Max is maxed out. Look at all this, he's maxed out. So we got to help him. He wants to do velocity banking, but he didn't have a line of credit. Do you see how the business in doing that is creating its own HELOC, right? I call it the HELOC. Your business gave you a home equity line of credit when the bank wouldn't, right? Your HELOC. Now here's what's great. Watch what happens. So, on this note, you got to come up with terms like how long is this, a 2-year note, a 5-year note, 10-year note? What's the payment plan on it? Is there a balloon? You got to put all that together, right? But here's the great part about it. At 0% interest, the payments from these credit cards are going to be set at 2%, right? 2%. So if you're lending out $25,000, 2% is the minimum payment. Well, that's about $500. So you're going to set up a $500 payment on the $25,000 note. But what does Max do? He's going to do his velocity banking strategy. He's going to take his $5,000 income, He's not going to put it up here on that credit card, no, because it'll just shrink down the limit. He's going to put it into this title company. He's going to pay the $5,000 note, but he's overpaying it because he's putting all of his income in there. So what happens is the title company going to take out their part. So that means $4,970,000 is going to go down to the company, and the company is going to pay the credit card bills. But what's this going to have an effect of? Well, look at this. So Max has his $25,000 limit through the business credit cards, and he's going to start consolidating the debt. He's going to start putting a limit up here. Go to, what did we talk about earlier? 13,000. He's going to consolidate that, and he's going to start using the velocity banking strategies that Ray covered earlier, right? Ray did a beautiful job going over all of these strategies. So here's Max. He starts doing his velocity banking. Every month, making those payments every month, paying it down. Then what happens when it's back down to zero? Takes another $13,000 chunk out of his debt and does velocity banking, sweeps that down. It's great. So let's in review look at what is happening here. Max puts his debt onto these business credit cards that he got as a loan. He takes his income and pays it to the title company. The title company sends the income to the business. The business pays down those credit cards. Now, Max is making these payments every month. He's putting in the $5,000, but Max has still got his expenses. What's he do? Well, he runs his expenses on the card. Keeps running expenses on the card, but he puts his income to the title company, which then sends it to the business, and the business pays all of those credit card bills. So what does that mean? What is happening here? Well, let's take a look. As Max begins to eliminate his debt, and he's paying off these credit cards, what's going to happen to his credit score? It's going to go up. Now his debt to income ratio, he's consolidating his debt, he's paying it down with velocity banking. So what's happening to his debt to income ratio? It's going down. Now if he does have these credit cards and he's paying them down, right, then his utilization is going down. Now, the credit score is going up, DTI is going down, utilization is going down. Over in about 24 months, Max has got some decent credit again. Hey, welcome back, Max. Take a look at Max over here. That's no longer a frown. Look, Max is happy, right? It's like life is returning to him. He's able to do his velocity banking. Down here at the business, what's happening here? Well, businesses need cash flow. Does Max have monthly income coming in? You bet he does. Look at this, $4,970 in reportable income. Bing! All right. What about credit? Well, every time the income comes in through the title company and he pays down these cards, he's getting what's called transactional history. He's making all of his payments on time. So we're building business credit. Bing! Again. It's awesome. But what about collateral? Very important piece. Look, does not Max have $25,000 in an equitable interest in this house? That's collateral. Here we are. He just started this business and he's already got cash flow, credit, and collateral. He's off to the races. And he can, if you can do this once, can you do it again? Can Max start another business? I mean, how many businesses are you allowed to have? How much business credit are you allowed to actually have? Max, look at this. He is happy. In this example, we're using Max here as the same person, but what if these are two different people? Well, be careful. Only work with people you know, like, and trust, and get actual contracts by licensed professionals, right? Make sure that when you're checking this, you're working with a CPA and a tax attorney, and that All of these strategies that I'm telling you work for you. While this is awesome, because you've got the HELOC, the velocity banking is working, once the credit score is where it needs to be, look at what happens here, folks. Max is going to give a personal guarantee back to his business. So the business has been going along doing this velocity banking, and things are going great because the business has built itself $150,000 of lines of credit. Not bad, right? But with the personal guarantee, the business could add up to another $150,000 with just the personal guarantee. And with the excellent business credit rating, it's not going to take very long to remove the personal guarantee. But think of that. Having a business with excellent business credit, having your personal credit where it needs to be, you've taken one person, turned them into two great people with great credit scores, and you could both go out, co-sign a loan, buy a quad, if you want. Why don't you, I have a lot of people, I was talking to a guy today, he wants to buy a fourplex. Imagine that, he lives in one unit, rents out the others, but not as regular rentals. He wants to do them as nightly rentals. Oh my goodness, there's so many wonderful strategies. But he, not having the ability to do that because of his credit, if he did velocity banking with business credit, he could reduce his debt faster, because there's three components you need for velocity banking. You need debt, you need income, and you need a line of credit. Well, Max, he just didn't have the line of credit until he did business credit. That's why business credit, and it's so optimal, because when you're using personal lines of credit to do velocity banking, you got to stick under your utilization of 50%. And really you should try to keep it under 30%. But that's not the factor. The utilization is not a factor with business credit. So you can use the business credit almost with impunity, as long as you pay your bills on time. Folks, this has been velocity banking with business credit. I challenge you, make sure you're texting the word credit to 602-497-2257. There you'll get a guide on how to build business credit, but also don't stop there. Contact us. Set up a consultation. You'll work with me or Ray Fleming, or contact CJ Wallace at creditwiz@investorpro.org, right? Here's the point, folks. This is very critical. Don't put this off. There's so many great things that God has planned for you. I believe that personally. I believe that to be true. You're here for a reason. You're sitting here listening and learning about these strategies for a reason. Don't just think, that's cool, I wish to do that someday. No. Do it now. Do it today. Implement these strategies. Imagine if you started velocity banking and business credit now, 6 months from now. Think about that. Where are we? We're not. Imagine come end of January, February, and you could be having $50,000 in lines of credit. What would that do? How would that change your financial landscape?
Start next year right.
Yeah.
Start next year right. Start now.
Yeah. Starting next year on the right foot begins today, right? But if you wait till next year and then your situation's even worse, it's going to be that much of a bigger hole to dig yourself out of. Folks, you've got so much to do with the kids and the spouses and the life and work and the dogs and all the things you got to do to take care of that. There's so many things that require your attention. Hire the professionals. Hire wise guys and ties. Let us work with you, help you build your business credit so you can get back to the things that are important to you while you're growing your business credit and you're achieving your financial freedom. Thank you so much. Good night. God bless you.